the short-term volatility in the market. There's a lot of volatility in the market as we're speaking right now. The days are up, the days are down. Sometimes we have, excessively large down days. The last couple of days in the market have been quite extreme in the other direction. So we've got extremes of volatility. And we were just talking before about how, the concept of the biggest up days often occur in bear markets. So how this short-term volatility, how does one address it? For somebody who's not using a structured approach, a buy and hope, or somebody who doesn't have a systemized approach, how do you deal with it?
Well, so we've just discussed, we've been talking about noise effectively and how to overcome noise and with statistical probability, basically statistical edges. And now we're talking about short-term volatility and compared to long-term outcomes, really what we're doing. And when we have short-term volatility, and mostly volatility is synonymous with down markets, and you'll see all the volatility measurements and indicators will rise when markets are falling. But in my book, Blueprint to Wealth, which was published some 6 years ago, almost to the day, there was a chapter in there where I spoke about the myth. And this big myth that that people put out there, and they say that and all the funds do it, and you can Google it, and it's still out there, that if you trade the market, if you go in and out, if you try and time the market, you're going to miss the biggest up days, right? And then they take out the 10 or 20 biggest up days over a 10-year period, and they say, oh, if you take these out, your returns will absolutely plummet. But the problem is that the big, and you can go and do this research, you can read chapter 7 of my book and find that this is an absolute myth. In that if you go and look at when all the big up days occur, they happen in the worst times in the market. So just extracting the big up days only and only leaving the big down days, and obviously is skewed logic. It's pretty pathetic to go along with it. So if you actually have a strategy that misses the biggest up days, you'll also by definition miss the biggest bad days. And you'll actually end up better off, right? So that's actually a case. They don't realize it. Maybe they do. They're just trying to pull the wool over your eyes. That it's actually good to miss the biggest up days. And that's, people struggle with that. People really do. And most people apply, they don't look below the surface, and they apply simple logic, affects people a lot. A sample of 1 or 2 means that therefore all the samples are going to be the same. And people get sucked into that because they don't look below the surface. But short-term volatility is probably the number one reason that people don't come to the market. If you really wanted to pin it down to one thing, it's people have extreme difficulty with short-term volatility and mostly down volatility. And it's probably the number one reason, because volatility also synonymous with down markets, which is synonymous with drawdown. And so our portfolios will actually fall when there's high volatility in the market. And what that does is people struggle with it. And what it does is a short-term volatility detracts them or takes them right off course from what their long-term plan is. And sticking to the plan, sticking to a long-term plan when short-term volatility occurs is hard. It's difficult. It's difficult for human beings to do because it goes against everything that we are, as the way that society programs us. So we have to build a regime psychologically and execution-wise and plan-wise and data-wise and evidence-wise that helps us stay the course, to stick through the short-term volatile times. And I'm not saying it's easy. It's the less times you've gone through it, the more difficult it is, and the more times you go through it, the easier it becomes, and the more trained you become at being able to handle this, both psychologically and execution-wise. And I'd say to people that you've got to go through probably 2, 3, at least 2, but more like 4, 5, 6 of these types of markets we've had for the last year to really be able to build that resilience, that psychological resilience, the execution resilience, and the evidence, looking to evidence and being objective and consistency resilience is really what we have to try and do from a skills perspective.
Yeah.